regardless of what's going on, regardless of who wins, you still have to invest for your future. I mean, and when you look at this sort of scary landscape, I think it's tough for people because they're almost paralyzed. Rob, they don't know what to do because nobody wants to lose, right? Nobody wants to lose anything. You've worked hard for this money. So I say to people sometimes, look, try not to look. It's tough, if you need that money in a few years. But I think about, the 529 plans, right, that people put in for their kids. It's the kind of thing where you don't really look at it, right? Because it gets heavily invested in equities when they're really little, and then it kind of evens out as they get closer and closer to college. But you just kind of put it there and you go about your business. There's that aspect to investing, but there's also another, which is that you want to be active, but active within reason. Does that make sense? I mean, I think that's sort of what we're trying to convey to people and the approach that we have with the portfolios. It's like when it's time to make a move, we'll advise that, but we also don't want people in and out and in and out and in and out. And by the way, you're going to get hit with taxes. Wow. Yeah. Like if you make a little bit of money, you're going to pay taxes on that. So there's some benefit to just keeping good, solid, strong companies for a good portion of time, because that's what actually builds wealth.
Yeah, absolutely. And it's risky. I mean, to kind of look at everything as a trade and to be in and out of the market. Even professional investors who are fully resourced and trained and spend every waking moment of their lives trying to figure out these opportunities, the results are quite mixed. So for an individual investor to, even attempt that, it just sort of defies common sense. I think, the better approach is to, take it, just say, look, I'm going to be in the market, and a starting point could be having broad kind of index exposure, right? The S&P 500 or other kind of major indices, maybe something more global. And then, individually look at certain companies, look at specific opportunities, and sort of build up a diversified portfolio of individual stocks that can, power, long-term returns for you. And I mean, that's how I invest, right? So really what I think we're doing here is we're kind of replicating, how we personally approach this kind of personal finance problem of kind of how do you grow your savings for the long term. This is what I think is, and I think what just really most people I find in the investment business, approach it this way. Professional investors themselves with their own capital.
Yeah, and I think it's really important, and not to get this whiplash, having come from the financial media space, and I've worked for all of them, Bloomberg, CNBC, and Fox Business. And I can tell you, look, if it bleeds, it leads, right? So when the market is tanking, what do? You go all in. Okay, huge sell-off to tell you about, guys, and you scare the heck out of everyone, right? And then you get great ratings. All right, so there are no bulls on the air on the day when you have red all over the screen, right? Because nobody wants to hear that. You're like, oh my gosh, what about the sell-off? And how much worse is it going to get? And there's like a hype factor that goes into it at networks and newspapers. And, it is what it is. And I think like what we're trying to do here, and what I'm passionate about doing, and I know you as well, it's like take a step back from that and think about the long-term scenario, because you can't get whiplash. Then you're in and out. And when you're in and out, you lose. You just lose. Like you have to have a position, be wedded to it. I mean, look, you don't put good money after bad. You cut your losses when you have to, but you need to look at the overall picture of things. I even think about in a bull market, right? I learned this years ago. I was a network news correspondent earlier in my career, and I was pitching a story. This is before I went to CNBC at a major network. And I was like, we got to do this story. It's a house of cards on basically the subprime debt crisis. So this would have been maybe 2004, 2005. I could not get the story on the air. I couldn't get it on the air. Like the news director was like, what are you talking about? We got the market at all-time highs. Nobody wants to hear this, Trish. Like nobody. I'm like, but I'm telling you, this subprime stuff, and I'm trying to explain it, and they're like, we have no idea what you're talking about. Well, we're not putting this on the air. I think, got it on one of the weekend shows. Do you know Nouriel Roubini, who's a pretty well-noted economist at NYU? He was talking about this at the time, and I interviewed him, and I'm like, this is interesting. This is fantastic. We have to do this story. I had talked to a bunch of hedge fund guys as well. Like, I heavily researched this. I had been thinking about it, of course, in my head leading up to that. I couldn't get it on the air, Rob. And this is because news sits on the curve, right? So if you're thinking long-term about markets, like it just doesn't work in the day of, hour of news environment. And I know you with your background, I mean, I remember you telling me, like, and I've told this story on the air, I'm like, Rob could not buy shares in oil companies like in March 2020 when oil was like $20 or something because, of various ESG rules that governed the funds that you were managing. I mean, the ESG stuff is nuts too. So I just think like your background, my background, we have a very crystal clear look at things. And it really helps shape how we're thinking about the future and investing. And so, I'll toot our own horn here, or maybe I'll go back to our stock pick, right? Our stock pick in the copper sector. Take a look, take that. Now, I wouldn't sell that, right? Like we still like that. And it's probably going to come off its highs. It's up 22% versus the overall market. But this is a company that we believe in for the long term.
Yeah, and look, I mean, it's like to your point on the media. I mean, there's not a lot of, I guess, ratings that are associated with telling people to find some really high quality companies and stick with them for years, or if not decades, right? It's kind of a boring message. You can't, how much can you say about it? But it's actually like the correct thing to say, and we try to make it more interesting. I think it actually is really interesting finding, this search for like the absolute best, highest quality companies that create value, and because you're looking for like that kind of like needle in a haystack, right? Like that real gems, and you want to
diamond
own
in the rough sometimes. No,
there's
it's true.
of,
And the right level to get in at, and understanding the management team, understanding the earnings projectile, understanding the dynamics of the overall economy, which includes even the political and tax situation. All of these things come into play. And so it's a lot. It's daunting for people. It can feel very overwhelming. So this is a little bit of holding anyway. And look, we're doing the legwork for you, right? So that's the good news. Anyway, just a reminder, everybody, subscribe to 76. Go to 76research.com. Obviously, you know what I forgot to do? Rob, you're going to have to, I forgot to tell everybody to subscribe to this channel. Make sure you do that. Subscribe to the channel. That way you will know when we are live. You will get our videos, which are almost daily. And we'll make sure that we cut up the show and that we give you some clips so that you can kind of digest this in smaller amounts, because I realize that there is a lot here. But if nothing else, go over to 76research.com, sign up, get the free stuff, get the 76 report. And gosh almighty, like I cannot say enough, like the model portfolios, that's where it's at, because you're going to get 10 to 15 stock picks. It's an amazing deal. Go check that out as well. And we'll be back very soon.
Yep. Trish, I have an idea right now too. If people have specific ideas that they want us to cover in these conversations, or do more in-depth kind of coverage of or work on, just go to the 76research.com. There's a contact us tab. We'll see those emails. Send us your ideas.
I'm going to put it actually in our live chat right now. HTTPS, just so that people have that's a good point. Yeah, if you guys have specific questions that we can help dive into, we will do that here. I'm so proud of this. Like, I'm so excited because it's been such a passion of mine to try and really offer more. I mean, obviously, I'm very steeped in politics and economics, but I have a very heavy background in markets, and that's where I started my career as well, in the investment banking sector. We've been talking about debt. I was on the emerging debt market side, sovereign debt markets, where we were trading the likes of Argentina, Venezuela, Brazil and Mexico. So I've seen my share of those banana republics. Thank you very much. I know what that looks like from a financial and political standpoint. Anyway, so I'm thrilled to be doing this. Great to have you here. Peace of mind, just asking about mutual funds versus individual stocks. And hopefully we did give some advice on that front. I think so if you're new and brand new to all of this, sometimes like the index funds, I tend to like even more than mutual funds because, the mutual funds, I guess this is sort of like, dare I say, right? The stock picks that we're giving, it's sort of like how would you say, like a fine-tuned fund?
Well, look, I've managed two mutual funds historically and worked for mutual funds for most of my career. So, yeah, I think this is like what we're doing here is like an alternative strategy. When you invest in a mutual fund, you're paying a fee for kind of professional security selection and portfolio management. And what we've done with the model portfolios is really just kind of reinvent that. We're kind of giving you the intellectual property. We're giving you the ideas. We're giving you the proposed weightings, and then you can implement those trades yourself. And depending on it could actually be a much more cost-effective approach because what we're charging, it's about $400 per year per portfolio. So if you think about, we're giving you all of this intellectual property, which would be pretty easy for you to implement individually within your own brokerage account. You're not paying a lot for that kind of professional management that you might be paying with an actively managed mutual fund.
Yeah, no, it makes sense. There's a lot of value there. Anyway, again, you can go to 76research.com. Feel free to give us some suggestions on topics that you're interested in, and we'll try and implement some of that here into the channel, if not into the newsletter, etc. It's great to have you guys all watching here today. Thank you so much for your time. Rob, good to see you. I'll talk to you later, of course, and good to have you all here. Until next time, 76research.com.